Silver isn't rallying. It's entering a phase where supply stops negotiating. And the weird part is how hard a lot of people are trying to explain this away as just another momentum pop. Because that story is comforting, it's clean, and it lets the system pretend nothing structural is changing. But the mechanism that matters most right now isn't in the headline price at all. It's in the plumbing. It's in the cost of carrying silver through time. It's in the way now is being priced versus later. And by the end of this, you're going to have a simple, ruthless checklist for the next 1 to 2 weeks. The level that matters, the spread that tells the truth, and the exact kind of price action that confirms this is a real tightening phase. Or exposes it as a blow-off that eats late buyers alive. Because if one line breaks, the math changes. In the last few sessions, silver didn't climb. It snapped into a new altitude, punched through the psychological ceiling, and printed numbers that force everyone to reprice risk in real time. When a market is healthy and liquid, it tends to move like a crowd. When a market is stressed, it moves like a trap door. Up fast, down hard, back up again, with no respect for anyone's feelings. Silver has been doing the second thing. It's tagged the low 90s, pulled back sharply, and still refuses to go quietly. And that matters, because violent two-way action during a breakout phase is not automatically bearish. It's often the signature of a market trying to discover price while different participants get forced into decisions they didn't get to want to make. Here, as the first street-level symptom you can feel without any fancy data. It got more expensive to trade silver, and the buying didn't flinch. That is not normal. When an exchange raises the cost of carrying a futures position, it's basically turning up gravity. It's saying volatility is high, risk is high, we want more collateral. Most of the time, that cools the party. Leverage backs off. Some specs tap out. The move loses its edge, but silver kept pushing anyway. And that's where the real pressure starts. Because the moment trading friction rises and the market still levitates, you have to ask a more uncomfortable question. Who is buying in a way that doesn't care about higher friction? And the answer is usually not random retail euphoria. The answer is incentives. It's risk management. It's positioning. It's procurement. It is somebody who has a reason to own it that S bigger than a chart pattern. Now, let S take the drama down one notch and get precise about what supply tightens actually means in a modern silver market. Because the lazy version is not enough silver in the world, therefore price goes up. That's a kindergarten story. The real story is about what's available, where it is, what form it's in, and what the market is willing to pay to get it right now instead of later. Those are very different things. And that difference is the hidden detail most people miss. Here it is in plain English. The spot price can be loud, but it can also lie. The curve doesn't lie as easily. When a commodity truly tightens, the market starts paying you to deliver sooner. The front end of the curve starts acting impatient. Nearby contracts get bid relative to deferred contracts. Spreads start screaming in a language most casual traders don't speak. And that is why I'm not going to ask you to stare at silver like a lottery ticket. I'm going to ask you to watch it like a supply chain under stress. Because if you do that, the market gets way easier to read. Let's talk about the paper versus physical thing, but like adults. This is not about cartoon conspiracies. It's about plumbing. Futures markets exist so that different participants can transfer risk. Miners, refiners, fabricators, manufacturers, jewelers, mints, hedgers, funds, banks, speculators. Everybody has a reason to be there. And not all of those reasons involve taking delivery of metal. In fact, most don't. That's fine. That's how the system works. But here's the catch. When enough participants want exposure at the same time, and the dealers who normally warehouse that risk decide the price of holding that risk has gone up, the market can gap. It can become discontinuous, and it can become reflexive. In a tightening phase, the market doesn't need no silver exists. It only needs the marginal available silver is expensive, or it's in the wrong place, or it's already spoken for, or it can't be converted into the deliverable form fast enough, or the financing and collateral cost of shorting paper silver just got more painful. Those are all different doors into the same room. And right now, multiple doors are opening at once. But that's not the part that matters most. The part that matters most is the calendar. January is not a neutral month. It's where positioning collides with fresh risk budgets, roll mechanics, delivery windows, and that subtle but powerful thing funds do when a new month or quarter forces them to rebalance. Add thin liquidity pockets and geopolitical noise, and you get a market that can jump levels in hours, not days, hours. And that matters because silver doesn't just trend. Silver ambushes. So when you hear why now, you don't want one explanation. You want a stack. You want mechanics, flows, constraints, and a trigger. And the trigger right now is the combination of volatility, margin stress, and time. Let's hit the margin piece for a second, because this is one of those boring details that actually moves markets. When the exchange shifts margin methodology and increases requirements as the metal rises, it changes the behavior of anyone who's short or leveraged. It makes the position more expensive to maintain. It forces more collateral to be posted. It shortens the leash. And in a market that's already moving fast, that creates a brutal feedback loop. Price rises, margin rises, weak shorts get forced to cover, covering pushes price up, margin rises again. That's not manipulation, that's math. And that loop is how commodities go from rally to event. And if you think this only matters to gamblers, think again. A lot of institutions use futures for hedging and inventory management. They're not playing a YouTube chart game. They're managing exposure. So when the collateral rules tighten, it can change the entire complexion of the market. Not because anyone wants it to, because they have to. Now layer in the fact that silver is doing this while broader metals are also hitting highs. That's important. When you see gold, silver, and industrial metals moving together, you're often looking at a world where macro stress is bleeding into everything. Geopolitics, policy uncertainty, supply chain hoarding, and the fear that money itself is getting less trustworthy. When that kind of bid shows up, it doesn't ask permission. It compresses time, and that's where the real pressure starts. But let's keep this anchored. Silver is not just a fear trade. Silver is also an industrial input. That dual identity is exactly why it behaves like this. It can be a monetary proxy in one moment and a procurement problem in the next. And when those two identities align, silver becomes a scarcity story. Here's what makes silver supply uniquely stubborn. A big chunk of it is byproduct production. That means you don't just turn on silver mining because silver is hot. A lot of silver comes out of the ground because somebody's mining for something else. So even if the price signals we need more, the supply response is slower and less elastic than people assume. Then you have refining capacity, logistics, and the very unsexy reality that converting raw supply into the kind of bars or forms demanded by certain parts of the market takes time. Recycling helps, but it's not a magic faucet. Recycling is also a process with lead times and constraints, and it doesn't instantly scale just because the price chart went vertical. That's the supply side. On the demand side, industrial usage is sticky. It doesn't shut off just because the price got uncomfortable. Manufacturers don't redesign product lines overnight. They can thrift, they can substitute in some cases, they can optimize, but there's lag. Then you add investment demand, and that demand is not polite. It shows up as, I want it now. It shows up as bars, coins, ETPs, vault allocations, and in stressed moments, outright hoarding. And when those streams collide, you get exactly what silver has been printing lately. Liquidity thins, spreads change, and price discovery starts feeling like a fight. Now, I want to give you the hidden detail in a way you can actually use. If you want to know whether silver is in a real tightening phase, don't just watch the spot price like it's a scoreboard. Watch the behavior around delivery, the cost of carry, and the signals that imply urgency. In commodity terms, urgency can show up as nearby strength relative to deferred months. It can show up as backwardation, or at least a curve that refuses to pay you much to wait. It can show up as weirdness in spreads that normally behave. And it can show up as the market punishing anyone who tries to short the front end casually. Why does that matter? Because the curve is the market's way of telling you whether the move is primarily financial or whether it has a physical heartbeat. If the move is purely financial, you often see excitement in the front, but the curve still pays you to wait because there's no urgent need for metal now. If the move is physically stressed, now becomes expensive. The market starts behaving like it would rather have the metal than the promise. And that is the core of a tightening phase. Now here's the part people get wrong, and it's important. You don't. Big inventory numbers do not automatically mean loose supply. The world can have plenty of silver somewhere and still have a tight market at the margin. Because inventory isn't a single bucket, there are categories. There's metal that is deliverable, metal that is eligible, metal that is allocated, metal that is unallocated, metal that is encumbered, metal that is sitting in a vault because it's a financial asset, not because it's waiting to be shipped into an industrial supply chain. And the difference between exists and available is where breakouts become squeezes. Let me make this tangible. Imagine a warehouse full of goods. On paper, it's stocked, but half the boxes are reserved. A quarter of the boxes are in a different city, and the remaining boxes are the wrong size for the customers who suddenly need them. Technically, you can say inventory is high. Practically, the market is tight. That's silver. That's why the curve matters more than the headline. Now let's zoom out globally, because silver tightness doesn't express itself the same way in every region. If you want early signals, watch the places where silver is treated as strategic input, not just a trade. Watch import behavior. Watch fabrication demand, watch mints and retail availability. Watch how quickly premiums and wait times change. You don't need a perfect data set to see it. You need pattern recognition. When a region starts importing more refined silver even as price rises, that tells you something uncomfortable. The demand is not simply price sensitive, it's necessity, or it's stockpiling, or it's a mix of both. And once procurement turns into stockpiling, markets change character, not forever, but long enough to matter for your next few weeks. Now let's talk about what institutions and big participants do during this kind of phase, because this is where retail investors usually get emotionally played. In a breakout phase, you get two kinds of pain. First pain, the market rips, and you feel like you're missing it. Second pain, the market whips, and it makes you feel stupid for entering. That's not an accident. That's what volatile breakouts do. They create urgency and regret, then they punish impulsiveness with a shakeout. And the people who survive those conditions are not the people with the strongest opinions. They're the people with the cleanest process. Hear us what a clean process looks like in silver right now. You separate trend signal from noise, and you define what would invalidate your thesis before the market tries to redefine your emotions. Trend signal is structure. Higher highs, higher lows, acceptance above a key level, and pullbacks that get bought without collapsing the curve. Noise is the intraday violence, the wicks, the headline spikes, the social media panic. A market can do all of that noise and still be structurally bullish. In fact, it often will, because volatility is the weapon used to transfer positions from weak hands to strong hands, and that's where the real pressure starts. Now, quick pattern interrupt. Let S do the simplest math that explains why $100 matters without pretending it. S destiny. At $90 silver, a $10 move is more than 11%. At $100, a $10 move is 10%. That sounds trivial until you remember futures are leveraged instruments, and institutions are managing risk in percentage terms, not in vibes. A 10% move in a commodity in a short window forces rehedging, forces collateral adjustments, forces position reductions, forces covering. It forces behavior. And $100 is not only a psychological round number, it's also the kind of number that makes headlines, triggers model-based reactions, and lights up risk systems that were calibrated for a calmer world. So the question is not, will silver hit 100? The question is, what happens to participants' behavior as silver approaches and tests 100? Because behavior is what moves markets in the short run. Fundamentals are what anchor them in the long run. And in breakout phases, behavior can lead fundamentals by an uncomfortable distance. Let's stack the proof points quickly, the way a skeptic would demand. Proof point 1, price action. The market broke into a new zone and stayed violent, but elevated. That's what breakouts look like when the market is trying to decide if a new regime exists. Proof point 2, trading friction. Margins went up, methodology shifted, and yet the market didn't collapse. That suggests demand that is less sensitive to leverage constraints than usual, or shorts and hedgers being forced into action. Proof point 3, volatility. Volatility has been bid like insurance. When a market is truly calm, volatility bleeds. When a market expects discontinuity, volatility lifts. It S the market, S way of admitting. We don't know where equilibrium is. Proof point 4, inventories and vault dynamics. Reported holdings can rise and still coexist with a tight float because in the vault doesn't equal available at the margin. Tightness is about marginal supply, not total supply. Proof point 5, global flows and procurement. Import behavior and strategic accumulation narratives are showing up alongside price strength, which tells you the bid is not purely speculative. Proof point 6, macro overlay. This is happening in a world where policy credibility and geopolitics are actively injecting uncertainty into capital allocation. When that happens, hard assets get a bid not because people love metals, but because they distrust the alternatives. Now, there's a counterpoint you should take seriously because it keeps you honest. When prices go vertical, you can absolutely get blow-off dynamics. You can get late-stage frenzy where demand is pulled forward, where the market overshoots, where everyone becomes a genius for a week, and then liquidity vanishes on the way down. Silver has done that historically. Silver can be cruel. Silver can punish certainty. So the right way to hold this thesis is not, this will go up forever. The right way is, this is a tightening phase until the market proves otherwise. And the market proves otherwise, through structure, not through your feelings. So what would weaken this story? If silver loses key support levels and fails to reclaim them quickly, that's a structural warning. If the market breaks down through the breakout zone and starts making lower lows, that's a warning. If the curve relaxes sharply, if now stops being valuable, that's a warning. If the market begins rewarding shorting again because volatility collapses and the tape gets sleepy, that's a warning. The tape will tell you, it always does. But you have to listen to the right channel. Now I am going to give you the 2 scenario lens you need for the next 1 to 2 weeks. Because this is where most people either make money or lose their minds. Scenario 1 is the controlled pullback and retest. This is the healthy scenario. Price cools off. It comes back toward the breakout zone. It tests a support band. Volatility compresses slightly. Buyers show up without needing drama. The market builds a base. That base becomes the launch pad for another push. This scenario feels boring compared to the rip, which is exactly why it works. It gives real money time to enter. It shakes out the leveraged tourists. It builds a structure that can support higher prices without snapping. Scenario 2 is the continuation squeeze. This is the cinematic scenario. The market doesn't give you the retest you want. It rips higher in thin conditions. It gaps on headlines, on positioning, on forced covering. It approaches $100 and turns into a behavioral event. In this scenario, you don't get clean entries. You get speed. You get air pockets. You get whiplash. It can be profitable, but it is also where people get emotionally destroyed because the same force that propels price up can reverse fast when liquidity disappears and profit-taking hits. And that's not the part that matters. The part that matters is your risk management has to match the scenario you're in. Here's the viewer psychology shield, because if you're going to engage with silver in this phase, you need armor. The market will try to make you chase, then punish you for chasing. It will try to make you panic, sell a wick, then reverse without you. It will use headlines like a strobe light. It will make you feel late, then make you feel foolish. And the only way through that is to decide what you're trading, the trend or the noise. If you're trading the trend, you do not let intraday chaos rewrite your plan. If you're trading the noise, you accept that you're replaying in a zone where you can be right and still lose because execution and timing become everything. So pick your lane and be honest about it, because silver does not reward ambiguity. Now, what do you actually watch next? Not 10 indicators, not 1,000 tweets, a tight checklist. First, watch the breakout zone like it's a courtroom. Does price respect it on pullbacks? Do buyers defend it? Or does it slice through like it was never there? That's your first truth test. Second, watch volatility behavior. Does implied volatility stay elevated even on pullbacks? That can signal that participants still fear upside discontinuity. Does volatility collapse suddenly? That can signal complacency, or it can signal that the squeeze phase is pausing. Context matters, but the change matters more than the absolute number. Third, watch the now versus later behavior. Is the front end being bid? Are spreads staying tight or getting stressed? Is the market acting impatient? That impatience is often the footprint of real-world demand or collateral stress. Fourth, watch for signs of forced behavior. This includes margin-related headlines, sudden liquidation moves, and that particular kind of candle where price drops fast without any narrative and then snaps back just as fast. Those are often position-driven, not thesis-driven. Fifth, watch the $100 magnet, not because it's guaranteed, because it's a behavioral level. If price approaches it and repeatedly gets slapped down, that tells you supply is showing up there or the market is pausing to rehedge. If price approaches it and slices through with no hesitation, that tells you the market is in an urgency regime. And if that happens, the next detail is what flips the whole setup, how it behaves after the first touch. Does it accept above, or does it reject and trap late buyers? That one observation can save you a lot of pain. Now let's address the skeptic's favorite objection. If silver is so tight, why isn't it a straight line up? Because markets don't move in straight lines when they're stressed. They move in jolts because participants are adjusting under constraints. Funds rebalance. Dealers hedge, producers hedge. Specs get margin called. Physical buyers step in on dips. Others take profit. And all of that happens in a world where liquidity is not infinite. The more stressed the market, the more discontinuous the path. That's not a bug. That's the feature that tells you something real might be happening underneath. And to be clear, tightening does not mean no pullbacks. Tightening can still include vicious pullbacks. In fact, tightening phases often include the ugliest pullbacks because that was when the market is trying to ration supply through price and shake out weak positioning. If you can't emotionally handle that reality, silver will teach you the lesson the hard way. But if you can handle it, you stop seeing pullbacks as betrayal and start seeing them as information. So here's the clean takeaway. Silver is in a breakout phase where supply constraints, collateral mechanics, and macro uncertainty are colliding. The spot price is loud, but the curve and the behavior around now is where the story gets honest. The calendar matters because rolls, delivery windows, and monthly flows compress decisions into days. Trading friction rising without killing the move suggests urgency and forced behavior somewhere in the system. Industrial demand and supply rigidity makes silver uniquely capable of turning a strong trend into a scarcity event. And the next 1 to 2 weeks are about whether the market confirms the new regime through a controlled retest or escalates into a squeeze dynamic where speed becomes the risk. If you're going to engage with this, do it like a mechanic, not like a gambler. Define your invalidation. Watch the breakout zone. Watch volatility. Watch now versus later. Expect psychological warfare through wicks and headlines. And remember, price can whip around violently even if the thesis is correct. Trend signals and noise are not the same thing. The market will try to blur them. Don't let it. And if you like this style of breakdown, where we don't worship the chart, we interrogate the plumbing, stick around, not because you need another bull case, but because you need a community that treats volatility like a tool, not a trauma. Next time silver throws a tantrum, the goal isn't to feel smart. The goal is to stay rational while everyone else gets emotional. Because if this one level breaks, the math changes.